All right, welcome everyone to the loan officer training with the mortgage calculator. Nick, can you go ahead and share the screen again? Sorry about that. I accidentally stopped it. There we go. All right, thank you. Okay, give us just a second here to go live on all the different platforms. Appreciate those of you tuning in nice and early. We'll get started here in just a moment. Hope everybody had a great day today and is ready to get into this awesome training here. All right, so looks like we're live on all the different platforms, so we will go ahead and get it started here. We'll take the chat off the screen for now, but go ahead and drop any questions you have in the chat as we go through here. But welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president Nick Hershey and our sales manager Jose Gonzalez. We are a lender specializing in non-QM loans, and what we do every Tuesday, Wednesday, and now Thursday evening at 7 p.m. Eastern is go through our loan officer training, where we do a deep dive into an actual training here. So tonight we're going to be talking about how to calculate self-employed income with a profit and loss loan. So our sales manager, Jose, with 28 years of experience and tons of experience in profit and loss loans, especially because that's one of the things we specialize in here at the Mortgage Calculator, is going to take us through a presentation. So Jose, if you're ready, let's go ahead and get into it.
Good evening, everybody. Thank you for joining us. It's ironic. I was just speaking with one of our MLOs a little while ago on the profit and loss loan. We were coming up with a solution to a borrower having to transition from full doc, and luckily, the P&L option is a great option, and you will see when I share the last slide in this presentation with you on the guide, some of the guidelines that we love, why it is such a great option. So profit and loss loans are for self-employed borrowers only, obviously. So they're a little tricky. So first, let me note that the profit and loss report we're talking about typically is going to be an unaudited profit and loss report. That's real important, right? Because an audited profit and loss report is almost like a tax return. Depending on the guidelines, right, the report can be prepared by a licensed CPA or an accountant or an active status enrolled tax agent. Now, you have to be sure to confirm if the option that you have selected requires the report to be prepared by an actual CPA and not just the quote unquote CPA, which most of these guidelines, when they mention CPA, they're talking about it could be an actual licensed CPA, an accountant, or an active status enrolled tax agent. Now, again, depending on the guidelines, some of the profit and loss reports can be self prepared by the borrower and only require third party verification by the quote unquote CPA. So, again, could be a guideline that requires it to be prepared, the profit and loss to be prepared by the tax preparer, or it can be prepared, self prepared by the borrower, just with a third party verification. Now, most options do require, and this is a tricky part, most options do require anywhere from 2 to 3 months business bank statements to verify the business activity, or business bank statement. I guess it doesn't have business, it have to be personal, but 2 to 3 months business bank statements to verify the business activity and income. Now, there are options that do not require the bank statements either because that's how their guidelines are, or in some of the guidelines, if you're at 65% or less loan to value, you also do not have to provide these corroborating bank statements. Now, real important to note on that, let's go to the next. So, who qualifies for a P&L loan? Now, again, I like to put in bold there that all program options will have guideline specific variations, right? It's only specific to that particular conduit. Like just like what we're talking about, they could be that they may not ask for the bank statements at all, or they may only ask for them if it's at a 65 greater than 65% loan to value, you're just going to have to review the guidelines for the option being selected and make sure that everything is okay. Now, we did mention self-employed borrowers only. Now, most guidelines will require the borrower to own at least 25% of the business in order to be considered self-employed. Now, your borrower could be a U.S. citizen, a permanent resident alien, right? They're not a U.S. citizen, but they're permanently residing in the U.S. They have the permanent residency card. No need to have a work permit if you have a permanent residency card. Could be a non-permanent resident alien. Now, non-permanent resident aliens do not have a permanent residency card. They are required to have an employment authorization document or have to have the visa type that allows them to be legally working here in the U.S. First-time home buyers are okay under the profit and loss options. Now, the P&L option is not applicable ever for foreign nationals, as foreign national program guidelines do not allow consideration of U.S.-based employment or income, unless your foreign national happens to have an investor visa, like an E1 or an E2 visa, for example, that allow them to legally work here by having their business and legally derive income here in the U.S. That would be a non-permanent resident alien. But if they do not have any type of an investor or work visa or any type of documentation that allows them to legally work or have a business here in the U.S., then you cannot consider any of that income. So then obviously they can't submit a profit and loss loan application. We have P&L loan options for primary residences, second homes, and investment properties. And very interesting, we have first mortgage and second mortgage options. The option I was discussing with our MLO today was a second mortgage P&L option. Now, as is the case for all of our non-QM products out there, 90% LTV is the maximum LTV for owner-occupied purchases, and 85% is the maximum LTV for investment property purchases. So what are the potential issues? And this is where we start putting it together now, right? Where we start making the connections now. It's interesting. One of these stories we love is one of our MLOs. She was new to the company. She had limited experience as an MLO, basically just doing agency loans, your cookie cutter type stuff loans. And she, like most of the producing agents do, she signed up for a leads plan. And lo and behold, she received this amazing lead, right? It was 85% LTV purchase. I think it was like $1,056,000 loan amount. Purchase price around $1.4 million. Somewhere around there, 1.3, 1.4, and the borrower already was coming with an appraisal that they wanted to transfer in their person, in their name. Everything was good. However, they had been denied by another lender, not by the mortgage calculator. They had been denied because they tried to force the issue. They went full doc, didn't make it. Loan got denied. They didn't have other options at that other, whoever they were dealing with. So they came to us and provided documentation. And then this MLO had a meeting with her, and she was thinking she was going to go bank statement, right? Well, after reviewing some of the issues that you can see here that a P&L loan can assist with, the issue that her borrower had, obviously full doc was way out of the picture. Tax returns did not support the income needed at all. But the issue they had to do this as a bank statement was unverifiable large deposits. The borrower, this was an investment property, the borrower, I think, received like 5 or 6 deposits in the whole year in their business, but each deposit was like $250,000. So when I asked her, I said, ask him on these large deposits, if they can document the source, right? Like show invoices, contracts, copy of the item, whatever it is, to document that that is income related deposits. Well, she came back saying, no, no, he can't. He says it's going to be tough. It's a little convoluted. So I'm like, okay, no problem. That is what the profit and loss is good for. But then I asked, does the borrower self-prepare their find out from the borrower if they self-prepare their taxes, or if they're working with a tax preparer slash accountant slash CPA that would be able to provide a 12-month profit and loss statement to support our value, our income. So next day, yep, everything's good. He has a an accountant that does his taxes. So he's gonna deal with getting us a profit and loss statement from the last 12 months. That was great. So did that. That loan closed with the transfer appraisal and everything in a little bit over 3 weeks. But it was a great example of how to use the P&L, how to not try to force the square peg through the round hole. She definitely benefited because she got 1.5% of 1,056,000. So that's about 16 G's. That's not bad. So again, potential issues where a profit and loss loan can assist. First bullet point, pretty obvious. Tax returns do not fully capture the cash flow for the business. That was one of the issues this person had, except they tried to go full doc. Not going to happen. Or if you were thinking bank statements, you could have either declining deposit trends, too many NSFs, too many overdrafts, unverifiable large deposits, which was their issue, or declining or low ending balances, which could mean to the underwriter that the profit margin is really a lot lower than it is, and you're going to need a lot of explanation and adjustments, and who knows what's going to happen if you were trying to force it as a bank statement loan with declining or low ending balances. So, how exactly do you go about calculating the income? Well, luckily, we're not accountants, right? We can just state what we need. And then obviously, when you get the report, you're going to look through it. You're going to see income, expenses, net income, right? So that should make sense. So obviously, review your P&L before you turn it in. Make sure everything adds up properly. However, what you need to note as far as if it's even going to be possible is you need to know that the business needs to have existed for at least 2 years. There are options for 12 to 24 months if the borrower's previous employment is verified to be in a field that provides the same products or services, or they had similar responsibilities as in the current business, where they were in some kind of a upper managerial position, or depend on what they're doing now in their business. But that's a key component where the exception there, if you get it, is going to be based on some good documentation, letters of explanation, all that kind of good stuff. But definitely anywhere from 1 to 2 years minimum you're going to need. Now, some options do allow the combining of profit and loss reports from 2 separate companies. They're going to have to be 2 separate complete reports. Now, please note that the expenses need to make sense for the type of business. What do we mean by that? Well, it depends. If it's a business that is like a service-oriented business where they don't really need machinery, there may not be any employees, or maybe a couple employees, depending what it is. If you have a manufacturing business with a warehouse and trucks and employees and all that, you're going to have a certain type of overhead that's going to have to be taken into consideration, and the P&L is going to have to reflect that, obviously. So, it has to make sense. Income and expenses need to be itemized as well. Now, this is critical for options requiring professionally prepared reports. Right? In the verification letter, because you have a report, then you have like a third-party verification letter, and the preparer of the report, CPA, tax preparer, or enrolled agent, needs to certify that they have prepared the borrower's most recent tax return. And then the CPA, and then they also need to prepare the letter on letterhead to provide the P&L covering either 12 months or 24 months and include a business narrative. 12 or 24 months, depending on if you chose the 12-month option or the 24-month option, obviously, because of pricing. Now, in some cases, it may be like the one I was looking at today for a second mortgage. P&L option was only a 24-month option. They did not offer a 12-month option in that one. And then note that the P&L needs to be either the last 12 months, most recent consecutive calendar months, or the last 12 months fiscal year. And then you're going to need a separate year to date. So if it's like they're going to go from January to December of 2023, then you're also going to need a January 1st up through year to date 2024. It's going to be a little bit more work. So it really depends. That depends on how they keep their record, and really depends on if the accountant wants to just go outside their comfort zone and prepare it for the last 12 calendar months, because then they're going to have to go into each month. They probably already have a 2023 P&L that they can just go print out. So this is here in our last slide here. This is a sample guideline from one of our conduits that we love to use. So you can see here how they're asking either for the P&L to be strictly the 12 months most recent calendar, or all separated out by years and year to date. I mentioned if you want like January through December, and then January 1st through year to date. Now here they even give you a cool link where you can verify the CPA, tax preparer, or enrolled agent, right? So you got a few different portals there: CPA Verify, IRS.gov tax professionals, and then they have this other one here, probably for the enrolled agents. So pretty good that they give you the link, so you don't have to go running around like a chicken without a head trying to figure out, how am I going to verify this tax preparer's PTIN? Well, that's how you do it. All that information needs to get verified. What I really wanted to mention here is what I mentioned about the 65% LTV. So it says for loans with a combined loan to value greater than 65%, right? 2 months of consecutive personal or business bank statements, or the most recent statement dated within 120 days of the note date are required, right? So 65% or less, that's okay. But here's the part that's really neat about this guideline. This is actually what really excited the MLO about this program. He's saying this here: total deposits reflected on the bank statements minus any inconsistent deposits or deposits unrelated to business activity must support at least 75% of the gross income reflected on the P&L. So issue there is, if the last 2 months were a little bit slower, no fret. They're not going to totally kill your deal. They're giving you a little bit of a buffer there. You only have to come in at 75% or greater from the stated net income in the last 2 months. P&L period must be consistent with bank statement period, and no more than 3 NSFs allowed. So on those 2 bank statements that you have to provide, please, check the NSFs. And here's where I mentioned the business needs to have existed for at least 2 years. However, the exception of 12 to 24 months. So this is just one of the conduits that we have. One of the options that we have as guidelines. We have many profit and loss loan options, each with their own tweaks to the guidelines. So depending what the particular need of the borrower is, then so you handle it accordingly. So it's not necessarily always going to be based on the interest rate. Obviously, the interest rate is always going to be good, but it is going to vary from option to option depending on the guidelines, because some guidelines are a little bit more relaxed. That means it's going to be a little bit more risk for the loan, which means it's going to have a little bit higher interest rate, because the interest rate is basically a reflection of the risk on the loan. You have to have a certain risk for a secondary to have an appetite or a specific interest rate for that risk for a secondary market to have an appetite to buy those packages. So that's really why we see all these different interest rate options for all these different loan options. It's not necessarily just a 10-year treasury that's affecting, and the 30-year that's affecting the 30-year, but other conditions like, these are all individual guidelines, not like Fannie or Freddie or Ginnie Mae loans.
All right. I don't see any questions here, surprisingly, but great tool to have, right? And saved many loans, right, Jose? Definitely saved many loans. All right. Well, no questions. So let's go ahead and wrap it up. Remember, every Tuesday, Wednesday, and now Thursday evening at 7 p.m. Eastern, we do these trainings where we go through a specific training topic for loan officers. So we will see you all tomorrow at 7 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.